The itrax is a brand name for the family of credit default swap index products covering regions of Europe, Japan, and non-Japan Asia. The most widely traded of the indices is the itrax Europe Index, composed of the most liquid 125 names of European investment-grade credits. Each name in the portfolio is equally weighted, representing 0.8% of the total portfolio exposure. There's also significant volume of trading in the high vol and crossover indices. High vol is a subset of the main index, consisting of what are seen as the most risky 30 constituents at the time the index is constructed. The crossover is constructed in a similar way, but is composed of 50 sub-investment grade credits. Each index is liquid in the 3s, 5s, 7s, and 10 years. In line with the new trading protocol established in June 2009, the itrax Europe pays 100 basis points per annum coupon denominated in euros and is settled via an upfront premium to bring the net price back to the par or current market spread equivalent. Similarly, the crossover trades on a fixed coupon of 500 basis points per annum. Every 6 months, March and September, a new rebalanced index or series is launched and associated on-the-run securities are issued. The rolling series ensures that the basket maintains its investment-grade integrity, specific to the itrax Europe and CDX indices, whilst also maintaining a high spread DV01 with limited slide exposure. Once formed, an index remains static over its lifetime, except for entities that default, which are then eliminated from the index. More on this last point shortly. The latest introduction to the index family are the two new sovereign benchmarks, the SOVEX. The SOVEX Western Europe can be traded for either 5 or 10 years and comprises 15 countries. Again, the index is equally weighted, such that each sovereign represents 6.67% of the portfolio. The CEMEA index, however, comprises an unequal weighting of those countries represented in the region. Both contracts are denominated in US dollars and trade in a similar fashion to other index products, i.e. on a fixed coupon basis with exchange of upfront premium. Why the need for new sovereign indices? Not only does the introduction enhance the index product family, but also facilitates an efficient way to take outright positions on a diversified sovereign basket, or indeed provide a mechanism by which to hedge general macro exposures. The addition of the two new indices also promotes relative performance trading between the Western Europe and CEMEA contracts or between SOVEX and other itrax indices. In other words, a long-short strategy involving, for example, the itrax SOVEX Western Europe versus itrax Europe. Let's have a closer look at what happens to the index in case of a credit event. In the first place, the index contracts restrict the eligible types of credit events to bankruptcy or failure to pay. Once a credit event has been evidenced, the entity is removed from the index and the contract continues with a reduced notional amount until maturity. Let us look at an example in more detail. Let's assume that a bank counterparty is long 125 million euros itrax Europe protection bought from a credit investor and that a credit event occurs on one of the index reference entities, for example in year 3. Since each reference entity weighting is 0.8%, the investor pays to the bank 1 million euros, 0.8% of 125 million, and the bank counterparty delivers to the investor 1 million of deliverable obligations of the reference entity. Credit events in the indices are physically settled. The notional amount on which premium is paid from that point forward is consequently reduced by 0.8% to 124 million. Following the credit event, the bank counterparty pays 100 basis points on 124 million until maturity. There is no substitution such that the index series that experiences a credit event will be now comprised of only 124 reference entities. However, the new series that will be established at the next roll will include the full 125 names. after the successful introduction of the benchmark indices, followed the equally successful single tranche products. They are fashioned on the technology of the collateralized debt obligations that offer investors a greater risk-reward spectrum. The standardized tranches are spliced and diced out of the benchmark headline indices. The most liquid tranches are those carved out of the two main investment-grade indices, the itrax Europe and the CDXIG index in North America. Each of these indices has 5 liquid tranches. Each tranche is defined by its attachment point, which defines the level of subordination of a tranche, and detachment or exhaustion point, which defines the maximum loss of the underlying portfolio that would result in a loss of the tranche notional. For example, the 3 to 6% tranche implies a 3% attachment point and a 6% detachment point. The tranche thickness is the difference between the detachment and attachment points. The notional amount of the underlying portfolio can be determined by dividing the tranche notional by the tranche width. For example, a 15 million notional of the 3 to 6% tranche implies an underlying itrax Europe notional size of 500 million, calculated by dividing 15 million by 3%. Since the itrax Europe and the CDX-IG are equally weighted indices of 125 different credits, the reference weight of each credit is 0.8% of the notional of the index portfolio. For example, exposure to 15 million notional of the equity tranche, 0 to 3%, implies an exposure to 500 million notional of the underlying index and a 4 million exposure to each of the individual index credits. The protection buyer of a tranche makes quarterly payments to the protection seller in return for credit protection on losses in the underlying portfolio. Under the new trading protocol, all tranches are now priced as percentage points upfront with 100 basis points per annum running yield. Premium payments are made until maturity or until the notional amount of the tranche gets fully written down following credit events. The protection seller makes payments to the protection buyer as long as credit losses are more than the attachment point of the tranche and less than the detachment point. When the total credit losses equal the detachment point, the tranche notional is fully written down. For each credit event that affects a tranche, the notional of the tranche is reduced by the loss amount and the premium payments are made on this reduced notional. In addition to default risk, a short protection position in a tranche is exposed to movements in spreads of the underlying pool of credits. An increase in some or all of the reference pool credit spreads drives the tranche mark-to-market negative. Increases in credit spreads are far more likely than defaults. Owing to the protection provided by subordination of the equity and BBB tranches, highly rated tranches are more exposed to this risk. Investors trading index tranches are exposed to a multiplicity of risks over and above default risk, such as correlation risk and recovery uncertainty, in addition to the spread movement as just discussed. How does correlation risk affect the value of an index tranche? As a tranche references the amount of losses in the underlying benchmark index, the correlation of the behavior of the reference entities in the event of portfolio losses is central to the value of a tranche. An increase in mezzanine and senior tranche spreads means that buying protection on these tranches will be more expensive. This indicates the market expects defaults in the portfolio should affect the more senior tranches, or that defaults are likely to be increasingly more correlated. As a result, spreads in the equity tranches will respond by moving tighter. The opposite is likely to occur with a fall in correlation. The salient point here is whether or not the trade position is long or short correlation. In short, an investor can be long correlation by either selling protection on the equity tranche or buying protection on the senior tranche. Similarly, an investor can be short correlation by either buying protection on the equity tranche or selling protection on the senior tranche. The sensitivity of a mezzanine tranche to correlation is function of its attachment point and tranche thickness, as well as its underlying credit spreads, and lies in between the equity and senior tranches. But note that correlation is non-static. The sensitivity to correlation can change through time as a function of spreads, defaults, and time decay. For instance, if all spreads in the underlying portfolio tighten significantly, a correlation-neutral mezzanine tranche would begin to take on the correlation sensitivity of a senior tranche, i.e. as correlation increases, the premium of the mezzanine tranche would rise and vice versa. Similarly, if all spreads widen, the mezzanine tranche would begin to take on the correlation sensitivity of an equity tranche, i.e. as correlation increases, the premium on the mezzanine tranche would fall and vice versa. However, the exact behavior of a mezzanine tranche would be a function of the magnitude of the spread change and the attachment points of the mezzanine tranche. The simplest trading strategy involves a naked position in an index tranche, e.g. an outright short or long position in a tranche. As with all unhedged trading strategies, an outright position implicitly expresses a directional market view. For instance, a short protection position in the equity tranche expresses a bullish view on spreads and defaults, i.e. that spreads are likely to remain at current levels or to tighten, and that defaults for any of the names in the portfolio will not occur through to the maturity of the tranche. On the other hand, going long protection in the more senior tranches is clearly a bearish statement on the credit market. Many investors use index tranches as a means to gain leveraged exposure to the credit market without compromising credit quality. So, to summarize the average objective of a long-risk investor, they are typically searching for yield enhancement via a diversified portfolio of credits, or, for the more conservative investor, for yield pickup with a more substantial first loss protection or higher level of protection afforded by a greater degree of subordination. As for the short risk investor, buying protection on the more senior tranches provides, perhaps, a less expensive route to express a bearish credit view than buying portfolio protection in the index outright.